what's at stake this earnings season? Let's discuss with Solus Alternative Asset Management's Dan Greenhaus. Dan, you come here on a point right where we're getting ready to kick off the earnings season with the banks. As we just mentioned, more market complacency with some tariff threats coming out of Washington. As we look ahead to earnings, is that what the market is waiting to move on?
Yeah, listen, the near-term concern is certainly tariffs. I would take issue with the idea that the market is complacent.
Fair, because?
I think complacency is the type of adjective that we've used over the last 10 years for any time, and I'm not saying you're doing this, anytime the market goes up when I think it should not.
Okay, fair.
Because I'm concerned about X, whether it's sequestration or the Chinese devaluation, all the way up to, obviously, today.
Okay.
I think the market's well aware. I think there is certainly a portion of the market that recognizes that some portion of tariffs will be higher today than we thought, and I think my own view is that we should probably have a little breather here for the next couple of weeks as we determine exactly what those rates will be, if higher at all, on August 1st.
So a breather because we just don't know?
Yeah, well, listen, I think when the original tariff headlines occurred on Liberation Day, there was a sense of shock and awe that, oh my God,
absolutely,
these numbers are astronomical. If they were to come to pass, the universe is going to implode on itself. My argument was that's not going to come to pass, and so the universe will not implode on itself. As that view became more mainstream, the market rallied back up. We had a bit of a pause in terms of the rhetoric. Scott Bessent started speaking was more prominent, and people like Peter Navarro, who the market was more skeptical of, took a step back. Now you're at the point where the president is talking again about higher tariff rates. That's going to take the effective U.S. tariff rate up even higher than we currently anticipate it to be. So my argument would be, while we determine exactly what that level is going to be, after a truly historic rally off the lows, some breather is in order. And just to frame this for the viewers at home, from top to bottom, from the post-Liberation Day lows, the U.S. stock market was up 26% over whatever period of days that was. That's the type of rally that you see off the 2009 low, off the 1974 low, off long-term capital management low. 26% or so in that shorter duration of time is really, really rapid and really, really strong. And so all I'm effectively arguing is, after what is effectively a historic rally, some digestion of that rally while some of these headlines come to pass.
Where do you feel about where valuations are sitting going into learning more about these companies in earnings season?
The market is expensive relative to its own history. That's for sure. But I think there are complicating factors for that overriding argument. One of which, of course, is the strength of the Mag 7, which trades at a higher valuation, deservedly so. I think everyone would agree, which drags up the broad market index. So there's two other ways you could look at it: the median stock in the index or the other sectors. And the truth of the matter is, the other sectors are expensive, but not nearly to the degree that one might argue that technology is. And again, that's because of the growth rates that you're experiencing in those other sectors. And I would add, the market's not really I think it's hard-pressed to look at any spot in the market right now and say, oh, that's clearly a bubble. Now, you can argue that in the CapEx expenditures in Mag 7, AI, et cetera, at some point it may indeed prove to be a bubble. But I think with the way that spending is going right now, investor sentiment, at least in that framework, is entirely justified.